Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with Shaun Burgess. You haven't seen Shaun in a little while. The moose has been fairly consistent, but Shaun is here with us today, portfolio strategist at Cumberland Advisors. We're just before the close today, and I wanted to cover a couple of things on the equity side, but I'm going to let Shaun open up because he sets the table a little bit for what I want to discuss. So we had what we think, because we're bond managers, we had what we believe was good news in the bond market today. What did you see?
Yeah, good news for someone could be bad news for someone else, right? So it was a pretty good week for bonds.
Yep.
Started out Wednesday with JOLTS. That set the stage.
And what is JOLTS?
JOLTS is a job openings number, right? The market was really looking for lower, right? Because this supports the idea of a Fed, or it supports the Fed cutting in September, right? Their next meeting. We had jobless claims on Thursday, and then today we had the big one, which was non-farm payrolls. Came in well below expectations. You got 22,000 versus expectations of 75,000. That's what the bond market was looking for. They're looking for data that really supports the Fed cutting in September 17th, actually, to be clear on that. So their next meeting. The next part of that, or at least what they're looking for next, is going to be inflation. That's next week. But Friday, today, you went from over the week about a 423, 424, all the way down to a 408.
And that's in the 10-year Treasury?
That's in the 10-year Treasury. The 30-year came down as well. You had a little bit of flattening. And when we say flattening, the long end comes down to a greater degree than the short end, right? That's flattening. That's what we're looking for. If you're on duration, which we're a little long, in both our taxable and exempt strategies, you want to see flattening. You want to see the long end doing a little bit better, right? So we got that this week. Had a really big move today. Taxables, as I said, down about 15 or 16 on the week. That's a pretty big move for the week, right? You don't normally get those.
No.
So you saw the same thing on the exempt side as well, right? Down about 15 or 16 out to the long end there as well. So a good move for bonds all in all, right?
And I know you're going to follow up with an example of what you're seeing in the market.
Yep.
But Shaun mentioned something I want to tie back to what John's been discussing, and that is, while the market has been range bound, the way we trade it has been fairly consistent. When we get that 10-year up north of 450, 460, 470, Shaun and the team have been fairly aggressive buyers. What happens there is our duration gets a little bit long because we're buying longer maturities, trying to lock in those higher rates. So I know Shaun wants to mention what he's starting to see in that market, but I wanted to describe how we're trying to manage that interest rate flow.
Yep, as a bond manager, duration is really what we look at in terms of our risk to portfolios, right? This week, I wanted to highlight a deal because I think it really speaks to the value. We talk about tax equivalent yields. We've spoken about it before. We've written about it on the website and some of our pieces. You really want to look for value, and we look at it on a tax equivalent basis for bond portfolios. This week we had New York Dormitory Authority. They brought a deal backed by state personal income tax revenue, so a very good credit rating on that particular bond, high AA. It's what we call a belly button bond. It's a bond every New York portfolio owns, right?
Yep.
Everyone has the name. Those bonds came 5s at a 493.
And when you say 5s at a 493, it was a 5% coupon at a slight premium to par.
4.93% yield to worst. So a 493 yield. Now, when you think about that on the surface, your 30-year Treasury is a 477 as you sit here today. That's pretty attractive. When you do the math and you work the tax equivalent yield, on a federal level, assuming 37% your top marginal rate, that becomes about a 745 yield. If you're a state resident, that becomes about a 9.5, somewhere in that range. So those are the kinds of things we look at when we look out at this market. Where can we find opportunity? Where does it make sense in terms of duration? And how can we take advantage of that for clients?
And day to day, maybe we have to withstand a little volatility in price, right? In statement price to lock in that kind of yield, because that cash flow doesn't go away unless the bond gets called.
Yeah.
And we went through 10 years, from 2010 through up until 21, where if your taxable equivalent yields were 4.5, you were happy.
Yep.
So we're seeing some real cash flow. Let me jump in here because what Shaun mentions with the bond rally has some other effects to asset classes. Last week's video was about the strength we were starting to see in small caps, and consistent strength, consistent for the first time in a while. I want to just share this chart with you because I find it interesting when I talk about consistency. This is quarter to date. So quarter to date is July, August, and the first few days of September. IWM is small cap core. What this is showing you is what are these different indexes performance versus the S&P 500 versus the big daddy. So we see IWM right about 500 basis points ahead of the S&P quarter to date. Been a long time since you could say that.
Yeah,
Even when we take a look at mid cap core, which hasn't been as weak as small cap, but hasn't been keeping up. Look at that. You're closing in on 200 basis points or 2% higher than the S&P quarter to date. I mention that because these areas tend to trade better on a lower interest rate environment. Why? Because many of these companies, their balance sheets don't look like the large cap balance sheets look. They still have to go out to the markets for debt. They're still trying to grow. Interest rates have a real effect on their business. So if the thought is that we've peaked in rates, and who knows if we have or not, even within Cumberland we argue about that.
We do.
But if we have, if the Fed's going to cut and perhaps the intermediate and longer end has topped. Now it doesn't mean it just starts to fall step for step with any Fed cut. Nope. But if it's topped, maybe worst case scenario from a financing standpoint is off the table for small and mid. So we are seeing that kind of strength. You see large cap growth still just outperforming the S&P, and large cap value still struggling with the S&P, below the S&P, about 100 basis points through the first two months in a week. So something we'll keep an eye on. Where does it affect our clients? It affects our clients on how we allocate capital. We've been underweight small caps. Do we have a position in small caps? Absolutely. Do we like to see them run? Absolutely. There may be a point where we have to bring that weighting a little bit higher. The market will reveal that. We'll try to keep our eye on reasonable levels. And in terms of overall allocation, we want to stay somewhat balanced in today's market. So I think we brought you some interesting information about what we're looking at day to day. We hope the Moose has an enjoyable weekend with his daughter getting married.
Yeah, hopefully so.
Yep. Okay, everybody. See you next Friday.